Hi everyone, 𝗖𝗽 Biniaz here with CPI Capital. I'm joined by 𝗖𝗽 Benesocky. Welcome, Ava.
Thank you, August.
We host CPI Academy YouTube show dedicated to adding value to our viewers' investment journey. We bring on experts and discuss all topics related to real estate investing. Please subscribe and like the video because that helps us a lot. We hope you enjoy the video.
Wonderful. Thank you, August. Hello, everyone. Today we are joined by Venkat Avasarala.
Oh my God, you killed it. It's Avasarala. Avasarala.
Avasarala. Sorry.
Welcome, Venkat.
Welcome, Venkat.
Thanks for having me, guys.
Awesome.
Venkat, why don't we just start off by you telling everybody about your background, please?
Sure. So I'm an electrical engineer by education and spent about 14 years in corporate IT, but got involved in real estate since like 2007 with single family, like most people. 2016 is when I started actively syndicating multifamily properties, B and C, mostly in DFW. I live in Plano, which is a suburb of Dallas, and it's been a great market. So in 2016, I started syndicating BNC properties and ended up syndicating about 14 existing multifamily properties so far, mostly in Dallas, but some in Arizona and Colorado as well. And it's about 3,100 units till date, about 300 million plus, maybe 320 million plus in assets under management. We have already sold 3 of these 14 properties and right now under contract to sell 9 more properties. So basically that's all our Dallas portfolio, and we'll be left with our properties in Arizona, Colorado after that. But early last year, early 2020, started dabbling with ground up construction. And I have 3 projects which are in various stages of construction right now. A 156 unit in Dallas, ground up construction, 100,000 square feet retail in a town called Fulshire, Texas, right next to Katy, Texas, which is a suburb of Houston. Very affluent community there. We got a corner lot right opposite HEB. So it's a one-off retail project. We are not so much into retail, but this opportunity came along. We have a good partner who understands retail. So we brought him on and doing this project with him. And in January of 2021, closed a piece of land in Austin Metro to build another 338 units. And I have another pipeline of about another 1,500 units to build between now and next 2 years.
Great.
Very, very cool.
Great job.
Incredible. Now, you mentioned that you started off in single family. What made you fall in love with multifamily to do the transition, just solely focus on multifamily?
Absolutely. Yeah. I mean, see, again, when I started buying properties in Dallas back in 2007 and the Great Recession happened and we were getting these homes once traded for $200,000 for like $50,000. It was just unbelievable. It was a glitch in matrix, not supposed to happen, but it happened and we pounced on it. And I was able to do about 20 homes, all of them in Dallas. I still have half of them. They always stay rented. A single family in Dallas, you would very rarely hear anybody saying that I'm having any difficulty rent. I mean, before the old tenant moves out, it gets rented. I mean, that's Dallas, right? I mean, we had fun doing those properties. But what happened is after 20 properties, Fannie and Freddie wouldn't finance them anymore, because I'm putting a 30-year or 15-year Fannie debt on these. And now after Great Recession, Fannie Mae came and said that, look, I mean, we'll fund you up to 20. And after that, you are on your own. And by 2015, when I bought my last single family property, what happened is that the market has risen so much that the prices you no longer can buy at $50,000. By the time they already reached around 150, 160. So it just is not profitable like it used to be. Then I saw the writing on the wall. And also one thing happened, right? I mean, whenever you go see the property, there's like 30 people out there and a wholesaler is asking, okay, write your price on a piece of paper and just put it in my hat. And I said, okay. And then he's supposed to do a lucky draw. And I was like, okay, I'm done. I'm not going to do this. So this is not scalable anymore. So I want to go into something which is much more scalable, and just pivoted into multifamily, which is BNC properties. The barriers of entry, at least at the time, was much higher than what they are right now. So you still were able to find deals and make a decent profit for yourself and for your investors. So I did that So that's mainly the reason.
That's mainly the reason. Okay, thanks for sharing. Now let's take a step back. Actually, what was you had your career before you got into real estate? What was the circumstance that made you leave that career and fully focus on real estate moving forward?
Great question.
Absolutely. So I grew up in India, and my dad's a civil servant. He works for government. So never in 1,000 years we would have imagined that his job is ever at risk. He works for state. Nobody gets fired when you work for state in India, and that's mostly true for US also, right? So that is my upbringing. And then I came here, went to school, got my master's in electrical engineering, found myself an IT job. And then suddenly I was exposed to this rude reality called layoffs, right? So I went to, this Fortune 500 company. I used to work in Dallas. So I went to office one day. And as soon as I approached the building, I saw these emergency services and all that over there. I was like, okay, something's going on. So I parked my car. And as I walked closer, I sensed a lot of commotion, people crying and all that thing. Like, what the hell is happening here? Well, layoffs are happening. So in this particular instance, people who worked there for 30 years on some outdated technology, and that's all they know, now they're getting laid off. And there's no way in the hell that they can find another job on that old technology, some mainframe technology. So that's why they're crying, right? So I said, look, I'm still early in my career. This was in 2007, just before the Great Recession. And I was like, maybe early 2008. So I told myself, look, that's not going to happen to me. I'm not going to just depend on this job. This is not like a guaranteed job, anything like that. So I quickly realized that I have to have some financial independence that I have to build outside my day job, right? So that is what I looked at several things. I looked at small businesses and all that, but everything else required me to be there. And I find that multifamily is much more scalable, something that I can leverage other people's time. I don't have to be there. It was very easy decision for me to go into real estate, but that's a big thing, right? I mean, it hit me on the face like, okay, I got to do something about it before I become one of that statistic.
Right. Now, go ahead, August.
Yeah, and those are the best kind of switches that take place because it's not a want, whereas it's actually a need.
Yeah.
You go to work one day, you realize what's happening, what's taking place, and how you could things could change overnight, and that realization comes in where the need that, hey, I need to either have an alternative source of income, or the industry I'm in as an employee might not be the kind of right path for me with the skills that I have. So.
Definitely.
Is great to hear that. Allow me to also ask you some questions about single family. Now, we're located here in Canada. CPI is a firm that partners with Canadians to acquire US multifamily. We love US multifamily and kind of the rent to value ratios that exist. Could you briefly tell us a case study on an average of what a single family home in Dallas costs, and what is the rent for that single family? And just to give you a quick ballpark figure here, in Vancouver, where we live, the rent to value ratios are 0.2%. So you're in negative cash flows for years trying to recoup. So it's very difficult to kind of find the right project. So now comparing that to Dallas, give us kind of a briefly on this, because you were involved in.
Yeah, absolutely. And we're getting there, right? We're not very far off from there. See, you have to understand one thing. Back in 2007, when I started single family, if you look at M1 money supply, which is tracked by Federal Reserve. So M1 money supply, there is M0, M1, M2, M3, M4, and so forth. But M1 money supply is cash, coins, cash equivalents, or something that you can quickly sell and convert into cash. So this is a measure of the cash in the country. So that number was $1.5 trillion in 2007, December. Today, that number is $18 trillion. So that's like 12 times more cash running in the country. It's not like we have 12 times more houses in this country than we had in 2007. It's not like we had 12 times more population in this country than we had in 2007. The only thing which went up like abruptly is the money supply, which the Federal Reserve and the federal government has injected into the economy to deal with two recessions, right? Back in 2008 and the one which is dealing with right now. So what happens is like, all this cash running around has to find its way into these existing assets. So what used to trade for $200,000 as a fair price suddenly jumps to 250, 300, because the cash is there. Cash cannot sit so much time on the sideline. It has to get into some kind of an asset. And that created this artificial inflation of all these real estate assets. And single family is the forefront of that. So back in the day when I used to buy properties at even at $100,000, right now that very house trades for 250, right? Back then I used to get underwrite to like something like 18% cash on cash. Right? Even after putting 25% down, you still get 18% cash of cash. And also just like apartments, there is a class A, B, C kind of thing.
Yes.
And, I used to focus on class B where people used to make about $60,000 income, right? $45,000 to $60,000 income. But if you go for a brand spanking new in a very good school district and all that, you can do that. But then again, you won't yield that much. So I was able to put together a portfolio which was yielding something like north of 20%, given what I paid, right, for those properties at the time. But now, even if you go into those Class B single family homes right now, you're looking at rent to value ratios maybe like a 0.8, 0.9 kind of a thing. So
still close to 1%.
Still close to one. Right. If the rents keep going up, which I think will in the single family space due to the scarcity of them, some people they want to buy a home. Now, if they cannot buy a home, they want to rent a single family. They do not want to live in an apartment. So those people will be driving up the rents on single family homes, right? So even if you get into like a 0.8 right now, in about a couple of years, you'll get to 1.0 on above. It's reasonable to expect that given the scarcity of the single family homes right now. But yeah, I mean, mostly in the real estate in US right now, all the returns mostly are driven by the appreciation than cash flow, like good old days. That's common across everywhere, and single family is no different.
Yes, very true.
Now I want to take a step back. I'm excited to talk about this topic, but let's talk about, and I'm going to change the subject here.
Step forward. Step back. We already took a step back.
That's right. Let's take a step forward. You were talking about scaling your business in multifamily, and of course, to be able to scale, you have to have that capital,
Yes.
that cash. Now, let's talk about raising private capital. Maybe you can let us know about the structure you use to raise private capital and how that's helped you scale your business. More cash,
Absolutely.
more you can buy.
Absolutely. Yeah, till date, I have raised about $85 million, all no large checks. I mean, there are like $75,000, $100,000 checks per investor, but we have several repeat investors and never did any marketing, never bought an ad, nothing. So it's very organic and done over the time, right? Because it took us like, 5 years for me to raise all this money. And I only raise money when I have a deal. I didn't do any funds, nothing like that, preemptively, nothing like that. And yes, it's really important. I mean, the equity that you can bring to the table obviously decides how much of a, how big of a property that you can acquire. And we started with 100 units. The very first property was 100 unit. We paid $35 a door, held it for like a year and a half and sold it for $45 a door. That was in Oklahoma, actually. That was the only property bought and sold in Oklahoma. It's a college town called Norman, Oklahoma. And the first raise was $1.2 million. So obviously started building list with about 50 names. These are the people, obviously you hit up your family first, right? I mean, so my sister invested in it and my colleagues from my IT jobs that, that I built, and also the network outside the work place also, right? You call it conferences, networking events, which happen, meetups. So started building that name by name, shake hand by shake hand, right? So get all these things, get all their business cards, put it in a spreadsheet, and started to build a database. And then it started as we do deals, as we send the checks back, as we doing what we said we would do, we started to get referrals, and referrals are very important. I mean, it gets you so far ahead in building this relationship with this new investor if that new investor is referred to you by an existing investor, right? They don't come to you with the guards up. It's like, man, this guy is trying to sell me something kind of thing. There's no such thing. I mean, we can directly jump into the conversation, understand their needs and say, well, this is for you, this is not for you kind of thing. And that helped. I mean, right now my database is about 3,000 people, and about 1,200 of them actually gave me money. And the idea is to grow up on that database.
Right. Beautiful.
Great. Thanks for explaining that.
Yeah.
Now, kind of, not taking a step back. So starting out with having a job, moving on to becoming a active real estate investor, scaling that business to get into multifamily, and then eventually kind of having a need for private equity and raising capital from friends, family, business associates, and eventually kind of from the public. Now, at a certain point, now I've listened to you speak on many different platforms, Clubhouse, for example, and I really enjoyed kind of hearing your story. But talk to us about your current focus, which is ground up development, which is a lot different from value add multifamily. Please talk to us about that kind of transition, and tell us about certain recent deals you're working at, or any deal that you've put through a full cycle of ground up development.
Absolutely. So you don't have to go very far, even like 7 to 8 to 9 years back from now, like early 2010s. If you see the cap rates on Class A, B, C, Class A used to be around 5 cap, Class B around 6.5, Class C 8 to 10, right? Which is how the world should work, because all these are not the same products. If you see Class A product versus Class C product, you have to do a lot of maintenance, a lot of upkeep in Class C versus anything else. And the collections, the credit quality of the tenants is vastly different from A to C. And if you see the collections, right? I mean, them actually paying is vastly different. So everything is different between A, B, and C, and they have to be priced accordingly, right? The risk of execution is much higher in Class C. That's where they used to trade at 8 to 10. But now if you see the marketplace, again, due to the hyper money supply in this country, all these A, B, C, they're all sitting on top of each other. They're all 5 cap or less. Some markets even 3 caps, right? Even a C-class property can trade for a 3 cap. So this is not how it is supposed to be. Because like I explained, they're all different animals, A and B and C, and they are no longer priced the same way. So now we have to ask ourselves, like, can I realistically go buy a 4 or a 5 cap C-class property, deal with that C-class tenants in middle of a pandemic? And mind you, that the C-class tenants, 60% of the people who still lost jobs and don't have jobs in this country right now are C-class tenants. 30% of them are B class and 10 class is A. So disproportionately, the pain is concentrated in Class C tenants. Now, if they're hurting, how can they pay us rent? And to exacerbate things, even managing these tenants are becoming an issue, right? I mean, the crime spikes up. I mean, it happens everywhere, right? When you're in tough times, when you're in middle of recession, people get desperate and do desperate things. So these Class C properties, so if you look at what's the current situation, they're overpriced, way overpriced, like from the beginning of the time, right? And they're hard to manage and hard to collect money and hard to turn a profit, right? There are some markets here and there which bucks the trend because of the rent growth, right? Let's say if you see Huntsville, Alabama, Phoenix, Arizona, Idaho, right? Spokane, Idaho. All these handful of markets are bucking the trend and producing some 10% rent growth. Everything works at 10% rent growth, but we don't know how long. But barring those few markets, the story remains. It just doesn't make sense like it used to buy a C or a B class property, paying 4 to 5 caps, dealing with those tenants in their current situation. It just doesn't make any sense. The risk to reward ratio is not there like it used to be. So, but if you look at construction, you can still build for, yes, lumber is going up. You Canadians have to work hard a little bit more and send the lumber our way because it became 4x. It added about 10 to 15.
Here too, the lumber price has gone up here as well.
Yeah.
There's a big discussion with a lot of developers and groups that I'm part of.
Absolutely. So yes, lumber is going up, but everything else is good in the construction, right? If you look at the interest rates, historically low, and the Federal Reserve and the federal government is suppressing them and will continue to suppress them, because if they were allowed the interest rates to raise, it's a pandemic, right? And there'll be a new pandemic where all these properties are worth 10 cents on a dollar, right? Because everything is pegged to the interest rates. That's why people are able to comfortably buy and sell at 3, 4, 5 caps, but they cannot let the interest rates rise. So we have that. We don't know for how long, but at least for next 3 to 5 years, we have this window where these low interest rates are almost guaranteed. And the second thing is, thanks to COVID, a lot of people are just moving out from these coastal markets and the rural markets, and they're hitting up these Sunbelt markets. And we suddenly have these influx. I mean, if you look at Phoenix, right? In 2020, Phoenix received 89,000 new people coming into the city. And not all of them came from, most of them came from California, but some of them would have come from a rural part of Arizona too, right? So they're coming here and then they're demanding these houses. I mean, you cannot just produce that many houses just like that because somebody showed up, right? So there is a scarcity of single family. The worst thing that you, as a developer of multifamily, the one you fear is single family. If there is a hyper supply of single family, you're done. You can never compete with it. Right. So, but luckily, again, right now, there is this terrible scarcity of single family. It's so expensive to build single family. And that is a receding concept, right? In 50 years from now, maybe nobody will build a single family, right? Because it's so damn expensive. The labor, the lumber, the copper, and the land, and the whole 9 yards, right? So that gives you this captive class A people who are trying to rent from you. And it's not like they move in and 6 months from now, they'll go buy a home kind of thing. That was always the worry. Especially if you try to build in Texas, where the land was so cheap and building people were able to deliver homes at 150, 160 a door, entry-level homes, like 1,600 square feet. That was always the worry with the Class A. You know, as soon as the interest rates drop, as soon as the single family prices drop, a bunch of Class A tenants will leave us and go into their homes. That was always the worry, but that's no longer the worry. So that's why Class A is really, really strong, right? The occupancies are staying high. The rent growth is actually a lot better in Class A than Class B and C, because they are the ones who got hurt less by pandemic. So just to summarize this thing, if you want to buy anything, a Class A, B, or a C, something existing, you have to pay 4 cap or 5 cap in any major metros where I would like to be in. But if I want to build in these same metros, I can do it for 6, 6.5, 7%, even today. So you see the spread between what you'd pay if you are buying existing versus what you can build for. And again, the barrier of entry is much higher now, right? Because not everybody can get into the construction like they can on an existing property. So for that reasons, I would like to play in the construction field for the foreseeable.
Got it.
Okay. Thanks for explaining that.
So you're opportunistic in your kind of investment thesis, and as the general partner, as another word, kind of a fund manager, since you're raising private equity, you make the decision of what is the best investment for me and my investors, and currently you see that as A-class multifamily apartment construction projects. Now, our show is kind of directed to all levels of real estate knowledge. So kind of explain that process. When people think about development, especially on multifamily, they're thinking about a developer going in and building something to sell it per unit, or here we call it strata, kind of every unit has its own title. So you're selling it. So the plan is to construct and sell. But in your case, you're not building to sell unit by unit. Talk to us about what that entails and how that works.
Absolutely. Yeah. So even if when you buy a value-add apartments, let's say there's a 100-unit apartment complex, rents are $200 off, you get in there, you add the value, the most value in the first 1 or 2 years. After that, and technically you should sell right there if you want to maximize your IRRs and want to give the money back to investors so that they can invest in a high return investment, just like you did for them again. No point in sitting on it for full 5 years, because the year 3, 4, 5, unless the market goes crazy like it did after COVID, and we cannot bank on that, right? If it happens, it happens, but you cannot plan on that. Okay, I'll hold it for next 5 years. First 2 years, I'll add ton of value. 3, 4, 5, another COVID will come. Money supply will increase, further increase. You cannot plan on that. You cannot underwrite that. So I'm a big believer that you got to sell in the first 2 to 3 years, right? But if you see the construction, It's a heavy value add in a totally different way. You're adding value to dirt. There's nothing there. It's just grass, right? Now you're erecting a building, putting people in, and providing housing for that community, Class A product with the Class A tenants and all that. So you add a ton of value right away. As soon as you build it and lease up, you're good. Now, the issue is with the Class A is, I mean, we know that, right? I mean, where the risk is less, the reward is less too. You don't add a ton of value after you built it and pre-populated it, right? And lease up. So that's why my business plan is to provide my investors a 21 IRR. And I was able to do that as by building it, leasing it up, and wait 1 year and then sell it. So about 3 to 3.5 years at 21 IRR, that's double your money, right? Like we discussed about, yes, of course, there's no depreciation in year 1. You'll have some depreciation from year 2 onwards. Yes, there is no cash flow for year 1, 2. You'll have some cash flow in year 3. But I no longer am chasing cash flow because everybody wants cash flow and they're paying ridiculous amounts of money to chase that cash flow. And by the time the last bidder actually wins the property, there is no cash flow. The cash flow is just on the Excel, right? In reality, it's hard to project that. So that's why I refocus my efforts on construction to actually help my investors build their wealth. And it won't be through cash flow. Nobody is going to get rich by 2%, 3% cash flow coming in every year, right? So that's why I want to do this 3 to 3.5 year outlay of investors' money where I build, lease up, wait 1 year. And I wait 1 year after I build it for 2 reasons. One, I want to qualify for long-term tax rates. So you have to wait for 1 year from the last unit deployment date so that you qualify for the long-term tax rates, because it's a big difference between the short-term tax rates and long-term. And the second reason I wait for that 1 year is that during the lease up, we give concessions, 1 week free, 2 week free, or whatever. I get a chance to burn off those concessions upon renewal, so that thereby increasing my NOI and maximizing my after sale value. And then I want to sell it to institutions. Now, who are these people? They are pension funds, endowments, REITs. These are the people who are happy holding these low yielding, high quality Class A products in their portfolio because their timeline is much longer, right? They as long as, like if you see insurance companies, in good olden days, they used to buy 10-year treasury bills from government because they yield 5 to 6%. They were happy. But now they yield until the election, they were yielding less than 1%. So, well, they have to generate some kind of an yield. So if they get a 12% IRR over a 10-year period, they're happy, which they will get with these Class A properties. It may not be an investment grade product for you and me. It may not sound appetizing for our investors, but for institutional investors, that's good. So, and institutions will always have money. There's always a buyer for a product like this who can buy these properties from us. So I'm building for institutions in a way.
Got it.
Okay,
Great point.
cool.
Great point. Another item I want to touch on is my personal background is in construction and development, going from single family into multifamily, but it wasn't for apartments rental. It was to build and sell. And the difficulties I was facing here, building in Canada and Vancouver, was the lengthy timeline that it took from a project to go from the rezoning phase and dealing with the city hall and construction process is much more expensive and longer than it's in the US. And by the time the project is constructed, you're in a totally different kind of real estate market. Especially Vancouver and Toronto are very much kind of foreign investor markets that are stimulated by foreign investment. So something would happen in China and it affects the market here in Vancouver. So those are the difficulties I saw as especially somebody who was trying to syndicate deals as such here in Vancouver. But for yourself, you're building a product that you are also going to rent out. You're going to manage for a year, and then you have a cash flowing product that's in positive cash flow, depending on the LTV, which are the institutions are literally lined up trying to, and the market shows that. I mean, the data shows that institutions are lined up to buy this product. So you're essentially purchasing, building, and now you have your end buyer already in place, ready to buy the asset from you. But since your business model is working and raising capital from investors, and your investors initially being your inner circle and eventually kind of growing wider and broader, were used to value add and used to receiving that cash flow from day one. Talk to us about the difficulty on the transition for the investor mindset, their requirements from you, them being used to it. And as we all know, it's to educate an investor just to get involved in a limited partnership or LLC structure, to be passive, explain that process and understand. It's difficult on its own. Now to again try to convert them in this new process. Talk to us about that. How was that process? Did you face any difficulties or hurdles with your investors? And yeah, if you could, please.
No, when I went to raise money for my first construction project, I had the same. I wasn't sure whether I'll be able to raise money, because all this while I've been telling investors about value add investing, cash flow, and all that. And suddenly I'm doing a 360 on them or 180 on them. So surprisingly, we actually filled up fast, because they also know what's going on. They are paying attention. They saw when they started investing. I'm going to refer to Dallas, because this is most familiar market for me. They invested in properties in early 2010s at 25 a door, and now their latest offering is 120 a door. They saw what happened. They know that it won't work for long, right? So they are ready and receptive for a new idea to safely make a little bit more money than what they're doing with these late stage value add game. Right. And they clearly understood the risk to reward is different, and kind of COVID actually make it easy, because after COVID, like we said, right, I mean, the most of the pain still that we are still out 8.5 million jobs in this country. And I would add another 4 million jobs as lost opportunity for creating jobs in 2020 and 2021. And we have to count them like that, because whether we are ready or not, whether pandemic or not, new people are entering the workforce. So we need money to 2 million jobs per year to keep up with all these people entering the workforce. So technically we are out 12.5 million jobs. So last time when we lost 8 million jobs back in 2008, it took us like 5 to 6 years to get them all back. Right? So it's fair to assume that more or less it'll be the same. So there will be pain in that C class space, the B class, B minus space, for the foreseeable future for next 5 years. So, and this is just common knowledge. This is just common sense. And investors are shying away from those riskier class C properties, especially at their valuation right now. Not everybody's, but most people, at least in my investors, they're receptive to the idea of construction.
So it seems like your investors are pretty educated. So that might be because of the quarterly reports and kind of the content you send your investors while they're invested in your process. But talk to us mainly about the cash flow, because cash flow is one of those items that we advertise a lot. Many projects here in Canada don't provide cash flow. If they do, there is no value add or appreciation. So it's kind of a rock or a hard place when it comes to real estate investing. Cash flow is one of those very important points that we advertise. How were you able to convince or promote an investment which didn't have cash flow from day one, and your investors were used to that? Talk to us about that point, other than the sophistication of the investor.
No, absolutely. I mean, like an example I gave you, right? Again, if you look at 5 year, even in cash flowing value add apartments, you add most value in the first couple of years. So let's say if an investment produced 100% return in 5 years, let's say that 60% or 75% of the return will be produced in the first 2 years. The remaining 25% return is produced in year 3, 4, 5, right? So it's better to actually sell it after year 2 and take that 75%. And yes, you won't have that cash flow because now you're selling it. But then again, you can go back and do the same thing again in a different offering. Invest for 75% in a 2-year horizon. What's wrong with that? Why do I have to stay in the deal for? So I started building from that. So you need to hit a higher IRRs. cash flow, unless you're talking about 10 plus, like I was able to achieve on my single family homes back when, like 15, 20, 25% cash flow, unless you're talking that, it's not going to change anybody's life. Extra $200 on a $100,000 investment a month is not going to change anybody's life. But if you give me 100, and if I can come back to you in 3 years and give you 200 back, probably it will. Maybe you'll buy a boat or something with that, right? So it actually changes your life. So that is how we started building up. And again, I was really surprised that it didn't need much of a convincing. They know where we are headed, and they were very receptive to this idea. And so one thing is the short term. You cannot ask I see some offerings where they say that, look, let's do this construction deal. It's a 10-year opportunity zone. It's like, whoa, a lot can happen in 10 years, a lot. And investors don't like outlaying their money for that long. They might need that money for health, for sending kids to college. Something happens to health, some family emergency, anything, right? So you cannot ask investors money for 10 years. And all this while I've been asking money for 5 years and returning them back on 3 years or less. But I want to stick to that 3 year. Give or take few months, it's okay. But 3 years is where I want to be. And when I structured deals that way, they were very receptive.
Great. It seems like your investors have trust in you. So we talk about this a lot within CPI, that many investors invest with the person, with the team, rather than the investment and the actual project or investment opportunity. So that's great that you've created that relationship and you continuously grow your business. If I may, before we get into that question, I want to touch on as well. Now, we talked about kind of your progress in this business. We talked about, not only you've scaled your business, you've also made a transition into a different asset class. Talk to us about being a syndicator, being an active real estate investor, and it's somewhat of a juggling act. It's very exciting. We love it. As soon as we kind of understood this concept of syndicated real estate investments, me and Ava fell in love with it and have dedicated our lives to it for the past 2 years. But what we realized is, as general partners in real estate syndicated investments, there are a lot of moving parts, and there are a lot of professionals and advisors and consultants that need to come on board to assist us. For example, in our case, we partner with active operators in the US, such as yourself, to act as our boots on the ground. So we kind of allocate that task to that professional, or same thing with our kind of marketing or legal or accounting. Talk to us about scaling your company and bringing on potential advisors or these significant kind of consultants to help you grow your company, and how you manage all of that.
Absolutely. So as a syndicator, I feel that my job is to constantly look out for opportunities to maximize return for my investors at a favorable risk to reward ratio. Yes, I can maximize returns if I go buy, if I raise all this money, go buy a Dogecoin or a whatever coin out there, right?
Bitcoin.
Maybe I can double their money by weekend, right?
Yes.
But where is the risk to reward ratio there, right? So it still has to give us a favorable risk to reward ratio at market or above market results. Especially after COVID, I keep hearing some syndicators saying that, well, we got to go back and reset expectations of investors. Hey, you're going to get 4% or 5% cash flow, at least on a spreadsheet. Not sure if it will come in reality. And maybe a 14 IRR or a 12 IRR or something like that. Then I said, look, everything else is going up in value, right? The inflation is here, whether the Federal Reserve agrees or federal government actually shows the real numbers to us or not. We can see in real life. I mean, everything is so expensive right now after COVID. And even if you look at the stock market or the cryptos or anything, right? All these returns are much higher than what they were before in COVID, and they should be, so that we can keep up with this inflation. And now you're telling me that I have to go back to my investors and they reset their expectations and lower them, that they have to give me the money and make less money than they used to, when everything else is more expensive and everything is, it just doesn't make any sense. So what my philosophy is, I have to be at market or above market. when I compare to the other asset classes, providing the same risk to reward ratio. So that's why, in my mind, I feel that, look, I put myself in a passive investment. I make passive investments too. And 21 IRR sounds good to me. Even after COVID, that's where I want to be. And I understand you cannot send me cash flow, but I need to have a favorable risk to reward ratio, meaning if you're building something, there better be a buyer for that. I don't want you to build something in the middle of nowhere and then we have to just keep staring at everybody's like, are you going to buy it? Are you going to buy it kind of thing, right? So as long that risk to reward ratio is there, as long as you can give me a 21 IRR, and as long as you don't ask my money for 10 years, 3 years is where it's going to be. So I modeled everything I'm doing based on what I would want as a passive investor. And that is how I'm going forward with these deals. Now, coming to, you asked that, okay, how do you bring the skill, right? So that's another thing that I have made a big shift. As soon as I left multifamily, well, not left, but as soon as I started to refocus my efforts outside of value-add multifamily. And by the way, I just closed a Phoenix apartment complex about not too long ago, 2 weeks ago, 120 unit. We bought it for 5.1 cap. We're going to do really well on that one. Whenever I find deals which can give me a compelling reason to jump on it, and it has to be off market. If you cannot work on a listed deal, it's my thing, As soon as it's listed, there's like 100 sets of eyes on it. And even if it's a deal at a whisper price, by the time it gets awarded, it will appreciate quite a bit, and the deal is killed by the time it's awarded. So once in a while, as these off-market deals come through, I'll still do the value add. I'm not opposed to it. I like them. But for the most part, I'm looking outside the value add multifamily. And what that means is I don't have experience building this ground up construction. And this is not something simple where I can say, okay, you know what, from today I'll be a developer, let's build something, right? Yes. I'm not going to learn at my investor's dime. So what I started doing is making some strategic partnerships with very experienced developers based in Dallas, Austin, and Phoenix. These are the only 3 markets that I'm looking at. And coincidentally, they're the number 1, 2, and 3 markets in the whole country for the population growth. Not the kind of population growth, not the babies growth. Babies growth is good for the future of the country, but it doesn't help you right now because babies don't pay rent, right? So that is the story more from Houston. That's why Houston keep showing up population growth, but most of the growth is babies over there. So I focus on the migration. Because they are the ones who pay rent. And these are the top 3 markets in the country. And I have, on all these 3 markets, I have more than one strategic partnership with developers there. And I'm getting into land development as well. So where you buy a land for, let's say, $2 a foot, and you do a horizontal development, rezone it, replat it, sell it in pieces to like $6 a foot or $7 a foot, and make a quick return for your investors in the 2 to 3 year horizon, right? So, well, I don't have skill set for all these things, but look, I mean, we're not trees, we can learn, right? So I'm working with with developers who've been doing this at least for 20 years in the market, in that specific market, and showing those deals to our investors and getting them funded.
Very, very good. Nice. Now, you mentioned Dallas was one of the top markets, but you also said that you're selling off all of your multifamily properties in Dallas. Can you let us know why you're deciding to exit all
Absolutely. Yeah, it's nothing specific about Dallas, but if you look at our underwriting, right? Traditionally, we underwrite, 3%? I think no good operator that I know underwrote anything more than, let's say, 3 to 4% rent growth. Even when we are growing at 6% rent growth in 2016 in Dallas, nobody underwrote it. Now, if it's more than that, that's good. The Phoenix property that we have closed last 2 weeks, right now, Phoenix rent growth is 10%. And it was like 8 to 10% over the last 3 years. But did we underwrite 8 to 10% rent growth? No, because it's not a good practice. We only underwrite 3 to 4%. So in Dallas, we used to underwrite a 3 to 4% rent growth and an expense growth about 2 to 3%, and leave that 1% gap between the income growth and the expense growth, right? That is what grows your NOI year after year. And after 5 years, you get to sell it for a certain cap rate and make a return, not just the cash flow, but that is how it used to be. But if you look at Texas and also Florida, right? And there are a few other markets like that, but these are, I never owned anything in Florida, but it's a lot similar to Texas in many aspects. And the one thing is we don't have income tax. Both these states don't have income tax, right? On the state income tax. So without income tax, how will states educate kids and do other stuff that city and counties are supposed to do? So they double down on property taxes. So both Texas and Florida, not so much, but Texas is one of the very high property tax states in the whole union, right? Will be in the top 5. And that number is growing quite a bit. And if you look at Dallas ISD, Dallas Independent School District, 80 cents on our property tax dollars goes to schools, and Dallas ISD is the largest one in DFW. If you see their budget, if you go to their website and see their budget went from 1.4 billion to 2.1 billion in a span of 5 years, from 2015 to 2020, 50% increase. So basically we are making 50% more taxes, right? I mean, that is what's funny now. Okay, maybe they're educating a whole lot of kids. Well, not really. Their enrollment went from 155,000 in 2015 to 150,000 in 2020. It actually went down. So something's going on here, right? Which is causing the school education prices to go up, and property taxes are going up like that. So no longer is it true where my rent is growing at 3%, expense is growing at 2%. The reality is rent is maybe growing at 2% thanks to all the supply Texas is getting, but the expenses are growing at 10, 15%. Now you put 2 and 2 together, what will happen if you let it continue year over year? Your NOI keeps shrinking. And this started happening more so from 2019 for 2 reasons. All these counties, which was very lax, let's say if you pay $100,000 for a property, they used to assess our property taxes on, let's say, $60,000. So 60% of what you paid. Now they're saying that, no, you owe me taxes on the full 100,000. So it's a shift. Texas behaved in a certain way until 2018, the taxing authorities, and now they're behaving in a completely different way. So there is a material change in that behavior, which is screwing up our numbers, right? So number 2 is the insurance. So we're blessed with all these tornadoes, hurricanes, 60 inches of rain a year, a lot of weather events here. And it's been like this from at least from 2008, as my memory serves. But a lot of insurance carriers stick here. They're taking loss every year, but they don't want to give up the market share because Texas is a growing economy and all that. So now in 2019, they said, you know what, it's been 10 years, enough is enough, let's leave the market. So a bunch of insurance carriers left the Texas market due to the high losses, due to the high weather events. And suddenly what happened is insurance prices, when in 2016, when I syndicated my very first property in Dallas, I used to underwrite $225, maybe $250 per unit per year. Now it's like $600, $700 in Dallas. In Houston, it's like $1,100. So the insurance prices tripled. Did my rents triple in 5 years? No. Only thing which doubled and tripled are the taxes and insurance, and they're big ticket items. So all this, just to summarize it, your income is growing barely at 2 to 3%, and your expenses are growing at 10 to 15%. And you cannot hang on to something like this for very long.
Makes sense.
So, and that's why, I'm just refocusing my efforts on construction for my future projects, and also it's been 3 years, right? On average, our 2,600 units that we are under contract to sell, the average lifespan on those properties under our hold is about 2.8 years. We are approaching the 3-year mark. So it's not like we are selling them early or a fire sale or anything like that. We're getting there. And we just put it in the market. We offered them as a portfolio and separately as well. But luckily, we have a buyer who offered on all of them and put all of them under contract.
Oh, very good.
Nice.
Okay,
Congratulations.
Congratulations on that. And thank you for explaining that. That's very interesting about Texas.
Oh no, maybe we can.
Yes. Sorry, we're asking you all these questions, but maybe you can share a project that you're currently working on with us, please.
Sure. Yeah, I am focusing on these Western states, namely Arizona, Colorado. I'm open to Nevada. I don't know what my investors are open to Nevada because you know why, right? They have heavy dependence on the entertainment industry, and still the unemployment rate is high over there. So, and then Idaho, I like Idaho. Again, I don't know whether my investors will be, because it's a smaller market, it's a sleepy market, and suddenly the rent started going up 10% there because all the remote job people, they started moving there. And then finally, Utah. I'm not holding my breath on Utah because it's a small market, very hard to get in kind of market. But these are the 5 states I'm looking to do value add. So I'm trying to look for deals over there or look for partnerships where I can show that. So I just closed my latest Arizona deal 2 weeks back. I don't have another one under contract or in near term, but I'm actively looking. But on the construction side, yeah, I mean, like I said, right. So right now, what's keeping me busy is this 338 unit ground up construction. We purchased the land, we acquired the land in January, and we're working with city and to get the entitlements done. Parallelly, we're working with lenders to lever it up to 85%.
Sorry, and what city is this?
Yeah, what city is
what
this
city
in?
is this?
So
in?
this is the city called Kyle, Texas, which is 20 miles south of Austin downtown on Highway 35, right? Just you drive 25 minutes. It takes 25 minutes from Austin downtown to Kyle. And again, it's interesting. Again, every project, when you go into the construction, you cannot just build it because you can, because you need to solve a problem. You need to have a good business case. And our business case for this particular project is, if you look in CoStar right now, a 2-bedroom apartment is $3,000 in Austin downtown. That's ungodly sum of money, especially for Texas. Texas was never like that. I mean, nobody has to pay $3,000 for a 2-bedroom apartment. But unfortunately, that's the case in Austin.
Vancouver prices.
It's Vancouver prices.
There you go. That's Vancouver prices. So our project, we are offering the same quality, but you have to drive. You have to drive 25 minutes. Yeah, you can work in downtown, but get in your car, get on that highway and drive south for 25 minutes. And we are right on the highway. Come live with us. We'll give you a 55% discount on that price. So our rents are only $1,450, right? So that's a business case, right? I mean, people would do that, right? I would do that.
Sure.
So that is the business case for that particular project. And if you look at our Houston project where we are building this retail, it's a very affluent community, $140,000 income, a median income in that area, a lot of kids, a lot of disposable income. Recession or not, people will always spend money on their kids, right? So especially affluent families. So we started this project as something called academics, and we want to attract the businesses which caters directly to those kids, those affluent kids who have discretionary, whose parents have discretionary money. So think about Kumon, think about, the basketball federation kind of thing, and we throw in a credit union there. So it's $100,000 square foot retail complex. So these are the 2 active projects that we are working, but I have another 3 or 4 more projects, mostly in Dallas, Austin, and there is one in Phoenix that we are putting a land to build our first ground up construction in Phoenix, Mesa. In Phoenix, in a town called Mesa, we are putting that piece of land under contract. We're going to build 100 units. That will be our very first project in Phoenix in the downtown Mesa area. So these are several projects, and I'm working on a land development project in a town called Sherman. Again, the idea is to buy 50 acres, chop it up into pieces, and get them rezoned, replatted, clear the shrubbery, and sell it in pieces.
Awesome.
So these are the kind of projects.
He's a busy guy, got a lot of projects, and I
that's good.
enjoyed what he talked about as far as how opportunistic he is when it comes to finding deals for his investors. And we'll put all your contact information below this video on YouTube. But if you like, Ava,
what is your number one advice that you would give to a passive investor looking to start passively investing into real estate?
So I would say passive investors is get educated and quit making all your decisions based on headlines, right? You wouldn't believe, right? I mean, people just can be lazy, right? Can be lazy when it comes to investing. And let me tell you why, right? So even I'm guilty of it. When I was on a corporate IT, I used to spend, whenever I want to buy a car, I used to spend like a month researching it, test driving it, so much attention. When it comes to picking the investments in my 401k, I spend 1 minute on it. What I do is I go, which funds in my employer's 401k performed the best in last year. I sort the results and check, 25%, and be done with it. Shouldn't it be the other way around? Maybe you pick a car in 1 minute and then investment, you have to spend a month before but we don't do that. It's so taxing on head. Our human brains want to avoid stress, complexity, and all that, right? So it's a human nature that we try to spend as little time as possible when things are complicated, when you have to compare things, analyze things and all that. So I would say that investors that fight that habit and put more emphasis on the numbers than making emotional decisions, following blindly, oh, this many people are coming into Texas, let's invest in No, I mean, how does it matter? I explained to you, right? How does, as an owner of an apartment complex, how does it help me with how many people are coming into Texas or Dallas when my NOI is shrinking? My rents are not growing, my expenses are growing, my NOI is saying, how do I care? What do I care, right? So do common sense investing. Don't blindly follow the headlines. Pay attention to the numbers, pay attention to where they're trending, and make your decisions by that.
Great advice.
Great advice.
Fantastic.
Hey, Venkat, we want to really appreciate you. Thank you for taking the time and joining
you.
us and giving us lots of wisdom and lots of information. Thank you.
Thank you so much.
Thank you so much. Thanks for having me, guys.